Hello, my name's David Miller. I'm the manager of Nexus Global Solutions Portfolio and the co-manager of Dynamic. It's early January, and so I think I should start by wishing everybody a happy new year. Let's get to the numbers for last year. Solutions was down about 6.8%, Dynamic down by 9.3%. Now, I don't like losing money for investors. Disappointing to report them. But then let's take a step back from that. Markets don't always deliver on an annual basis. In fact, in my career of 38 years, 27 of them have had corrections of this sort of magnitude, and yet the indices have gone up 17 times. So I think we have to accept that there will be volatility, and what we try to do is to minimize the downside whilst making certain that when we get to the next upswing, that the portfolios are properly positioned to make a good return. And our objective for both is to make a medium-term good return. Since inception, both funds have done that and they've delivered good returns to investors. The other point to make about portfolios is that they have yields of around 2.5%. Compared to cash, this is a great return in income terms, and on top of that, the income is on a rising trend. The companies that we're investing in tend to pay higher dividends, and that's one of the reasons we select them. So that was last year. I'll come to the reasons behind that very briefly before moving on to next year. To start with, economic growth last year was good. Company earnings went up very substantially. Inflation remained low. Interest rates went up a bit in the US, but nowhere else. That's normally a good foundation for investment. And yet we had a de-rating of all financial assets. In fact, a report from Deutsche Bank that I was reading said that 93% of the assets that it tracks went down last year. Behind that, I think, is that reversal of quantitative easing, easy money being pumped into the financial system since the credit crunch of 2008, and that's now reversing. And I think that's behind the de-rating of markets over the last 12 months. Hard to judge when the right time is to be in and out when you have something like that happening, but that's, I think, where the problems lie. Not politics particularly, much more to do with just the amount of money in the system and what people are prepared to buy and sell at times like that. So that was last year. Where are we now? Dynamic, the equity portfolio, is 95% invested in equities, 5% in cash. Solutions is the diversified portfolio with about 29% in fixed interest and cash, 56% in equities, and the balance in alternatives. What's in those different assets areas? Well, starting with solutions, in the fixed interest and cash side, we've got a heavy emphasis on top quality government bonds, multi-currency. So we're not particularly exposed to any particular movement in the foreign exchange market. And then at the other end of the portfolio, the alternatives, such things as gold, which has performed well, hedge funds, which tend to be less correlated to equities. Those are the ones we've selected. They've also added value, infrastructure, property. All of those have been adding value to the return last year. So really the issue has been around the equity section of the portfolio, and there the emphasis is on diversification globally. The US is where we focus most of our attention. It's the biggest economy, it's been growing most rapidly, has the most innovative companies. The focus is very much on quality. Companies that make a profit, pay dividends, don't need too much borrowed money to actually open the doors every day. Might sound old-fashioned, but that's what you do. That's how you handle a period like this when the importance is defensive, play defense, not offense, for this period of uncertainty. So that's where we are at the moment. Now, looking forward to 2019, a number of the issues that were troubling markets towards the end of last year, prospect of higher US interest rates, possibility that the US economy might slow down, the chance that the Chinese economy might slow down, the future of the US and China trade dispute. All of these issues are fixable, all right, and they're in the market at the moment. We understand these risks, and I think it is wrong to assume that because these issues are there, that it means that you shouldn't be invested. I think we could well see improvements in all of those areas. And then for those more interested in the UK, and to be honest, these are not UK-focused portfolios, but Brexit is an issue. It's causing uncertainty, but again, uncertainty can often be followed by certainty, and what we don't want to do is panic out. So the plan for 2019 as we enter the first month or two of the year is as follows. We want to be focused on quality. We want to be patient, watching the numbers as they come out, making changes as necessary to the portfolios, and to be prudent. And I think those are the foundation stones of the way in which we're managing these portfolios during a period of uncertainty, but making certain that we don't have to make that rapid decision that suddenly everything is perfect and we need to get back in. We're in the right types of companies, we've got the right spread of assets in our opinion, and as events unfold, we have the ability to adjust the portfolios in order to take advantage of events in order to continue to deliver that medium-term growth of value that is our objective. So that's where we stand at the moment, and I look forward to reporting to you in a month's time. Thank you.